Hi everyone, this is a short screencast for Independent Colleges Dublin for the ACCA P6 IRE syllabus of Advanced Taxation. And this screencast pertains to FA2013, so it's relevant to exams in 2013, June and December. And within this first part of 2, I'll be introducing capital gains tax and really trying to give you a fix on the basic elements, really what you need to know before you come into the more complex areas of CGT. And certainly my experience of students dealing with P6, IRE, and indeed the UK syllabus is that the ones that do better have a really firm grip on the mechanics, the basic mechanics of CGT, and have an ability to score really the easy or the cheap marks. So this is quite a useful introduction to CGT, I hope. Okay, so moving forward in terms of CGT at a basic level, really what is it? Well, for me, it's sort of a subtraction. And what I mean by that is that an individual in the question will be disposing of, let's say, an asset or a series of assets. And when that individual disposes of the assets, he or she will receive proceeds of some kind, a sales proceed. And what you're looking to do is really to take that sales proceeds and to deduct costs associated with that asset or costs associated with that disposal. So really what you have is proceeds less cost equals gain. And it's important to remember that it doesn't really matter how complex the question gets, whether or not there's a relief thrown in or anything else, is that three-liner doesn't really change, and you'll score marks for simply stripping out of the question those elements, the proceeds, each of the costs, and subtracting one from t'other. Okay, so in terms of how that three-liner manifests itself in a slightly more complex way, well, really what you'll have is types of costs, selling costs, and also acquisition costs. And selling costs might be something like perhaps auctioneer's fees or perhaps legal fees associated with the sale of the item. In addition to that, you'll have some allowable costs. Now, the big one is going to be the original cost, in other words, the historical cost of the asset. But over and above that, you may well have some costs associated with the purchase of the asset. Again, look out for the word fees, things like valuation fees or perhaps estate agent fees, that type of thing. So although this is slightly more than 3 lines, you'll see the principle is the same. Proceeds less cost equals gain. Okay. Now, in terms of a sort of a calculation of the tax, really what we've got to do is to associate disposals with a 3-liner. So we may well have, let's say, 4 or 5 or 6 disposals in the question. We've got to come up with what we call a total gains figure. So if you imagine, and I'll show you this in a slide or two, if you imagine a set of 3-liners that have a series of gains, you're looking to total all those gains up and bring them onto your CGT computation, giving you your total gains figure. Now, one word of caution here is just in the area of losses. We've said that we might have a question with 4 or 5 or 6 different disposals. Now, those may elicit a gain, but they also may elicit a loss. So for our current year situation, in other words, we're dealing with FA 2013. So we're looking at disposals between the 1st of January and the 31st of December. And really any disposals, whether or not they elicit a gain or a loss. And we're going to lump them into our sort of current year pot. Okay, so once we net them off, let's say that it's a positive, i.e. it's a gain, then we bring that figure up to our CGT comp. But do bear in mind that it may well be that the losses in the year are at this level and the gains are at this level. So in effect, we end up with a net loss for the year. So we don't actually tax that. We can't tax a loss. So contrast that with the situation that you see here where we've got total gains, but it looks as if we're bringing forward losses from a previous year. So if you imagine the scenario in the previous year, or indeed in previous years, so there could be multiple losses. In those years, let's say just take the immediately preceding year, we had a situation where the losses outweighed the gains. Okay, we couldn't tax the loss, so what we did is we decided to carry it forward. In fact, we had to carry it forward under legislation. And the only way that we can relieve losses in a year is to either offset them against current year gains or to carry them forward. We can't carry them back to the previous year. In fact, the only situation that we can do that is on the death of the individual, and we can carry them back for up to 3 years. So, normal situation, we have more losses in the year than we have gains. We offset them and we carry forward the balance. Now, once we carry forward the balance, we need to offset that balance or those losses brought forward against our total gains in this current year. And once we do that, we get to our net gains figure. Once we get there, what we do is we take off our annual exemption. Now that's just a sort of an absolute amount in 2013 for our syllabus. It's 1270 euros. So really what we're doing there is we're saying, well, from our net gains, we're simply going to take off an absolute value of 1270 to give us our taxable gains. Okay. Once we have our taxable gains, we tax at 33% in our current year. Note that that's changed from FA12. So any resitters who are looking at this screencast, note the change in the rate year on year from 30 to 33, a 3% increase. Okay. So really that's how we would compute a CGT payable figure for a given question. All right. So moving forward from that, here's a sort of a manifestation of what I've been talking about in a slightly more meaty fashion. And really what you can see here is that although I'm using a sort of a cut and paste from the BPP text for 2012, and note that the rate is 30 there rather than 33, the figures would basically be the same. So these figures are just made up just to give you an idea of how a sort of a fully blown computation will work for a given disposal. So in this instance, what you can see, it's very much our three-liner again. We have our proceeds, and then we have less costs of sale. Okay, we have a series of costs here, other costs outside of the cost of sale, which are sort of just the original cost of acquisition, and also an enhancement cost. All that means is that we purchased an asset, we've enhanced it over time, in other words, improved it, and that cost is allowable as well. Don't worry too much about the figures here. These are just indexation figures, and I'll come up in the next few slides with some details on how you would calculate any indexation. All that indexation means is that for most costs within our three-liner, we can uplift them to current levels, current value levels, so that they're reflected at the current time. So that's in effect an additional cost that we're deducting from our proceeds. So what you'll see is once we take all these costs out, we've got our capital losses brought forward, and bear in mind what I said about the distinction in the treatment between a current year loss and a brought forward loss. So current year losses are just dumped into our normal pot. Brought forward losses are from the previous year, and they're deducted first once we have our net gains. Over and above that, you'll see that we have our 1270. That hasn't changed from FA12. It's the same value. We get our taxable gain, and then we just tax at 33%, not 30, as you see on the screen. Okay, so reasonably straightforward at this level, and bear in mind we're getting marks literally for just stripping out this information from the question. Okay, so moving forward from this sort of simple computation, I just wanted to give you a fix on, broadly speaking, how your sort of answer might look when the questions start to get a little bit more sort of complicated. Now, I appreciate you probably can't read the right-hand side of this screen, but you don't really need to see the detail. All that we're talking about there is really having a page 2 of workings, and then you can see that I have a page 1 of a CGT computation. So the reason that I've done this is that regardless of whether or not, as I say, the question gets complicated and you're producing a report for a tax partner or a report for a client, try and get a fix on the fact that capital gains tax is about really 2 main areas of your answer sheet. The first one has to be you working out really the 3-liners. So you'll see on the right-hand side here, you'll see that really all this page does is work out what the gains are in relation to each asset. And you'll see that there's one here, and then there's one down here. So really, I'm using my page 2 to summarize each of my three-liners. Now, these three-liners are very simple disposals. There's no capital gains tax relief. There's no sort of funny business. But, broadly speaking, this is how it would work, even for a more complicated question, in the sense that I've got to aim for some sort of total gains figure from each of my disposals. Yeah, and this is on my page 2. So if you imagine a report, it might have a sort of an appendix in the exam, and you've got to have some sort of area to work out each of your gains, or indeed possibly your losses. But in this instance, we're just talking about some gains. Now, once I have that figure, really what I'm looking to do is to really take that figure from my page 2 and really bring it up to my page 1 here. Yeah, which is my CGT computation. So you'll see I've got total gains figure there, and from the previous slide you remembered, take off brought forward losses first to get my net gains, then my annual exemption at 1270, then my taxable gains, then I tax at 33%. Okay, so again, very simple representation, but try and get a fix when you're approaching CGT questions, and they will get a lot more complicated than this. Try and get a fix on how is your answer going to look before you lay it out. I think one of the problems that students have is the questions get very, very complicated, and they struggle to know what to do first. Okay, so what I would be doing first, more often than not, is saying, okay, this individual has disposed of a series of assets. I need to work out what the gains are, or indeed the losses, for each of those assets. So let me do that first, maybe in an appendix or a schedule or whatever. Once I've got that, then I've got to have an area of my answer sheet that helps me to work out the tax. So let's bring my gains up to my page 1, take off my losses, take off my AE, and then multiply by 33%. Okay, so do try and get a fix on that basic area before you move forward. Okay, so in terms of further detail, a disposal, we've talked about proceeds less cost equals gain. Now, an asset will be sold, simple enough to see that there's a proceeds, and perhaps simple enough to see that there's some costs associated with it. But a disposal for CGT purposes under our legislation could also be what we call a gift of an asset. In other words, I could give an asset to another person and not charge them anything. So what's my disposal in that case? Well, my disposal value is my MV. So just bear in mind that there are many, many different ways for a CGT transaction to take place. It doesn't have to be a straight sale. It could be simply a gift. And as far as the revenue are concerned, if that asset is chargeable, in other words, is not exempt, if it's chargeable, then they want to see a three-liner. So you're going to have to come up with proceeds less cost equals gain. If there's no proceeds, what do we use? As I say, MV. Another situation, we could have a disposal at undervalue. In other words, I could give an asset or sell an asset, but not at the correct value, i.e. not at market value. And what the revenue will say was, well, our gain, or what we want to tax, is depressed. Yeah, and in that instance, what the revenue want to do is they want to deem the proceeds to be at market value to increase their gain. Okay, so just in this area of whether or not disposal takes place, just bear in mind that there's several possibilities. It doesn't have to be a straight disposal of an asset. Now, one or two other areas like compulsory purchase order and value shifting. Again, compulsory purchase order, just where perhaps a local authority forces an individual to sell an asset to them. Okay, so watch out for that area. I'll come on to a little bit more detail on that in a moment. And value shifting, a disposal is taking place if there's some element of value shifting. And maybe what we mean by that would be something like, let's say, a majority shareholder who holds a controlling interest in a private limited company, doing something that shifts value from their holding to another person's holding. When I say doing something, I don't mean simply selling something. I mean perhaps doing something like maybe passing a resolution that gives the other person's holding greater voting power, maybe giving them control. So although the transaction is not a straight disposal of an asset, something has shifted from one person to the other, and the revenue are looking at the transaction saying, well, okay, you haven't made a disposal as such, but look at what's happened in practical terms. You have a shift of value from your asset, your shares, which were a controlling interest, to someone else's shares who now has a higher value as far as we're concerned, and they'll charge the differential there, or the change. Okay, so in terms of CGT rates, we've already mentioned 33% from the 5th of the 12th, 2012, a 3% increase, so resellers watch out for that one. In terms of the date of disposal, now for our tax year, obviously we're looking to calculate gains on disposals that take place between 1st of January and 31st of December. Okay, so a normal situation would just be that John Morrison, your examiner, would simply state that John disposed of an asset on this date. Well, that's great. It's easy to see whether or not that date is within our dates. Okay, but there may well be curveballs in this area. And the first rule that I would draw your attention to is really the contract date. In other words, if a contract date is mentioned in the exam question, then as far as we're concerned, that's the date of disposal. The contract date is the date of disposal. So that's fairly straightforward. But we could also have a situation where perhaps there's a contract, but there is a condition attached to the contract. In other words, I will sell you this asset if this happens. So if this condition is in play. And in that case, our date of disposal is the date the condition is satisfied. So just watch out for those two. In terms of a compulsory purchase order, it's really the earlier of the two dates that you see, either the compensation being agreed or the date that the local authority enters onto the land. So in this area of dates, really just make sure that we're trying to capture disposals within our tax year. What they could do is perhaps give you a disposal that's outside the tax year. So these are the rules that we need to know to make sure that we're only dealing with disposals in our tax year and not in another tax year, and therefore taxable at a later date. In terms of payment of CGT, fairly straightforward, albeit for the fact that the individual tax year that we're dealing with is sort of split into two. In other words, we're saying, well, when do we pay the CGT on this transaction? Well, again, it's all based around the idea of when is the disposal date. So you'll see that the tax year is in effect split into sort of two parts, the first 11 months up to 30th of November, and then the month of December, with the relevant payment dates being on the right-hand side, either the 15th of the 12th following the first 11 months, or the 31st of January following the month of December. So pretty straightforward. Again, something we just have to learn. You often find within questions at P6 IRE that they'll tag on a little bit of administration onto the end. So we're not talking about 5, 6, 7 marks, maybe 1 or 2. But again, we need all the easy marks that we can get. So this is just a question of just rote learning these dates and laying them out in an answer to get perhaps a mark or maybe even 2 if we're lucky. Okay, so moving on from here, just a sort of little recap. So where we are so far is that I've said that you can equate capital gains tax to subtraction. Proceeds less cost equals gain. Okay, it doesn't matter how complicated the question gets, that cannot change. And I'll draw your attention to those sort of 2 pages that we have. We had page 1 being some sort of computation, and page 2 being a workings page where we're laying out all our 3-liners. Now, as I said, that was a very simple representation of 3-liners because there were no reliefs, there was no sort of fancy business in there. But it doesn't change. So try and think like that when you're laying out answers. Use the space that you have. There's no penalty for using paper, as I say in the classes. Try and get a fix on what your answer looks like, and really make decisions to get your 3-liners out as quickly as you can. In terms of sort of information for resellers, just draw your attention to the change of rate at 33%, and just watch out for the tricks around the area of dates, in other words, the date of disposal. Okay, so moving on from here, in terms of further detail, really, We talked about a three-liner. We talked about just stripping out the proceeds from the question. But there are instances, and I've touched on one or two, where the proceeds are not the proceeds. Now, the specific instances where that would be would be really where there's some sort of perhaps connection between the person doing this disposing and the person receiving the asset. Okay, now two instances on the next slide that are relevant in this scenario really are, and the first one being what we call connected parties. So in other words, where there's a relationship, or at least the revenue feel that there's some sort of connection or relationship between the two parties. And in that case, we have to use MV for proceeds. Okay, and similar to that, and I'll give you a definition of connected parties in a moment. Similar to that is perhaps where the parties aren't connected, but the transaction would appear to be something that's not at arm's length. In other words, perhaps the proceeds are, for one reason or another, depressed. And what the revenue want to do, again, is they want to stick in MV for proceeds. Because if you think about it, if we have a transaction where the proceeds are in some way depressed, then the gain must be depressed. And the revenue are looking at the transaction saying, well, the gain's depressed, therefore our tax is depressed. We don't like that. We want you to substitute whatever proceeds you used for MV, okay? Which will mean that the gain will be increased, therefore tax will be increased. Okay, so in terms of the detail on connected parties, who is connected with who? Well, really, as you'd expect, I would be connected with my spouse or my direct family relatives and indeed their spouses. Now, other areas you might not sort of expect would be things like a company is connected with the person who's a controlling interest in it. So if there's a transaction between those two, as far as the revenue concerned, that's fine. But as far as we want you to use MV as your proceeds. And that will make sure that our gain is as high as possible, therefore our tax is as high as possible. Okay, so this area here of connected parties, we just really need to learn who's connected and really do as many questions as possible. There's only so many ways that John Morrison, your examiner, can examine this area. The more you see them, particularly under timed exam conditions, the better you'll get at dealing with them. So as I've said down the bottom left there, just beware of your proceeds where you see some sort of connection between the two parties. Okay, I'm going to show you a sort of a little example in this sort of area now. Let me just move this a little bit for you. Now what you will see here, and I'll give you a chance to sort of read this in a moment, what you're going to see here is just a sort of an example of sort of a connected party transaction where there's a restriction on the use of the loss. So we have two people. We have Michael and his sister Mary. There's an asset being transferred, or gifted in fact, from one to t'other. Yeah. Now Michael is had a cost associated with that asset of 7,000 euros. Okay. Now because he's gifted, there's no proceeds. So in effect, the asset has a loss attached to it, or the transaction has a loss attached to it. Now, we've had to slot in the deemed market value because, again, there's no proceeds. So we have a loss, but here's the twist. What the revenues say is, okay, well, that's now a normal transaction, but as far as we're concerned, because you are connected, because Michael is connected with Mary, they're going to restrict the use of that loss. In other words, they're not going to allow us to use a loss with a connected party against gains on other transactions. So you remember I talked about a little pot that we're going to use to slot in gains and losses for our current year, all of them into a pot. Okay, and we're thinking that that's probably going to come out as being a gain, an overall gain. Well, in this situation, here's a loss that we cannot put into that pot because the two parties are connected. So not only do we have the MV rule here for connected parties, we also have a restriction on the use of that loss going forward. Now, how can Michael use that loss? Well, unfortunately, he can only use that loss against gains to Mary. or gains from Mary. So in that situation, it may well be that there are no further transactions. So he's going to be stuck because he'll have a loss that he cannot use. Okay. Now draw your attention down here. This is, by the way, just cut and pasted from the FA 2012 text. Question 3, December 12 for P6 IRE. There was a deemed connection between an individual and a trust. Okay, so this is a good example of this type of situation. So just watch out for restrictions on losses between connected parties, or indeed the use of them. Okay, so moving on from here, the calculation of CGT, well, we sort of touched on that already, so we should have a broad fix on how that works. We know that we're using our three-liner. We know that it's simply subtraction, really. Proceeds less cost equals gain. And in terms of deductible costs, well, there's quite a few. I've mentioned original cost. I've mentioned sort of cost of acquisition or incidental costs of disposal. Certainly my view on this area, as I've said, is, if you're in doubt about a cost, I would deduct it. 8 to 9 times out of 10 in my experience of teaching tax across different syllabuses is it's rare that a cost isn't deductible. So, make a decision and move on. At the end of the day, you've got a 50-50 chance of getting it right. Okay. Now, in terms of an instance where perhaps a cost wouldn't be deductible, the sorts of things that I've seen would be something along the lines of perhaps an item of perhaps investment advice, or indeed maybe something like repairs to the asset rather than an enhancement. So those sorts of costs wouldn't be allowable against normal proceeds. But certainly in my view, as I've said, if in doubt, I would deduct the item. Okay. Now, in terms of specifics on costs, again, I've mentioned several of these. I draw your attention to this sort of cutoff date we have here of 5/4/74. Really, in effect, that's our sort of baseline date. Okay. Now, if we have a situation where the asset is purchased prior to that date, then what we need to do is we need to actually find the MV at that date. Okay. In addition to that, you'll see down the bottom there we have enhancement expenditure. I've mentioned that. That's just this idea of I buy an asset and then I improve it in some way. Note that that's not repairs and maintenance, as I mentioned previously on the previous slide. We're looking for costs that are improving the asset. Okay, so quite a few different types of costs there. As I've said, if in doubt, I'd be inclined to deduct. Watch out for this area of an asset purchased pre-5/4/74, where you're given two values. In other words, you're given the 5/4/74 value and you're given a value perhaps in 1970. You're looking to lose the later value. Okay. Right, moving on from here, in terms of further detail, here's a very, very common trick that I would say make sure you get a fix on. Now, in terms of an intro to this, really, if I said to you that I had a set of 4 chairs, and those 4 chairs 25 years ago cost me £100,000, so they must be very nice chairs. Now, if I said I'd sold one of them, on first principles, if I had to come up with a 3-liner, you'd probably say, well, okay, if you've sold one chair, yeah, and you had a cost of £100,000, then the way that I see it is that the cost that you put into your 3-liner must be a quarter of £100,000 or 100,000 euros. Well, in fact, it isn't. And this is really why tax examiners examine this area, because in order to establish the cost where we're disposing of part of an asset, we actually have to use a specific formula, and it's called the part disposal formula. As you'll see up on the right-hand side, this is often examined. Okay, so this is something that you must get your heads around. In terms of examples, I would say farmland, or even just land, or really sets of anything, sets of chairs, etc., etc. So the problem for us is, how do we work out the cost where only part of an asset has been disposed of? We can see the proceeds because the question says John sold 1 chair from 4 for 50,000 euros. So we can see the proceeds, okay, but it's the cost bit that's the problem. Now, I'll take you through what I mean by the formula. And you won't see this in the BPP text, but this is what I would use, or this is how I would be inclined to remember it. The formula for part disposal is just A over A plus B. where A is the proceeds of the part disposed of, B the remainder, the value of the remainder. Now, these two items will be given in the question. Yeah. So again, it's a little bit like just us stripping out these values and putting them in our formula. So how would we work out the cost? Well, really what we'd say is, well, we need to come up with a gain. We have the proceeds, so there's our top line. Now the cost element must be the original full cost multiplied by our formula. So whatever it was, 100,000 euros multiplied by A over A plus B. Okay. Now, again, as I said, these values are given in the question. We simply take our original cost, multiply it by A over A plus B to give us the cost of the part disposed of. In effect, what they're saying is it's not a straight pro rata because the value of the remainder, i.e. a set of 3, is different from 3/4 of 100,000 euros. Okay, so we're going to do a little question here. I'll just give you a moment just to read this before I take you through the answer. Okay, so what you'll see is this question, by the way, is taken from page 153 of FA 2012, not 2013, but I'm pretty sure the questions will be the same in your current year textbook. Now, what you'll see is that we've got 15 acres being sold out of a batch of 100. So we're trying to say to ourselves, well, okay, I can see the proceeds value quite clearly, but how do I work out what the cost element is? Okay, so remember, A over A plus B times the cost is going to give us the cost. So let's look at the answer here. What you see, very simple representation of figures that are basically all in the question. The proceeds is given in the question. That's easy. I'm going to get a mark just for doing that. Now let's go down to the cost element. What you'll see here is original cost, and that's full value, yeah? And then we use our formula, A over A plus B, yeah? Figures given in the question to come up with this. So what we're saying is this is the cost attached to those 15 acres, and we've worked it out simply by using our formula. Now don't worry about this at 1.819, that's just the indexation up. Just try and feel comfortable with the idea of using that formula when you see part disposal of an asset. Okay, so hopefully that makes sense. And as I say, it's a very, very common exam trick across just about every syllabus that I've seen. Okay, so in terms of a recap, really that's the sort of the end of part 1 for you. I'm going to come on to part 2 and deal with 1 or 2 more complex areas, including some issues of development land and married couples, etc. So hopefully that's been helpful to you. Watch out for part number 2 coming very, very shortly. And thanks for listening.